Hey there, everyone. Welcome to my show here on Stockcharts TV. I'm Dave Keller with Market Misbehavior, President and Chief Strategist of Sierra Alpha Research. I'm so thankful you're joining me here on my weekly show on Stockcharts TV. Today we're going to be talking about small caps. I feel like for much of the last 12 months, I've either been asked by viewers of my content, I've asked others in interview situations, when are small caps going to start to improve and start to outperform? We've seen a number of sort of false positives through the course of the last 12 months. A couple times during 2024, it appeared like it was going to be the moment, the big moment when small caps started to really dominate. Never really came to pass. And through the course of 2024, owning anything but large cap growth probably caused you to underperform for most of the year. So today I want to talk about small caps from a technical perspective. What can we learn by looking at the chart of the Russell 2000 ETF? What kind of key levels and patterns and signals are we looking for? Then I'll give you three particular tailwinds which could help small caps to outperform, things we would be looking for as signs to validate that sort of bullish small cap thesis. Now, before we can talk about small caps, of course, we have to just talk about the overall conditions in the market, and I would think the best way to do that is by looking at the daily chart of the S&P 500. I would say no denying from a technical perspective, we've been in a period of distribution for the last 3 to 4 weeks. After the S&P made a new all-time high around 6,100 in early December, we're now currently right around 5,850. Now that horizontal line on my daily chart, if you follow my daily market recap show called Chart This, which you all should, you will see that we bring up this chart every trading day and talk about what we've done relative to that line in the sand. Now, end of last week going into this week, we finally closed below that level. And on Monday, we again sort of closed below 58.50. Today, as we're recording this kind of midday Tuesday, January 14th, we're trading almost exactly at the 58.50 level. So I think through the course of this week, as we go through more inflation data, as we start to get a bunch of earnings coming out, I think where we end the week relative to that 58.50 level could be very telling about what may come next. But that's not the only reason why I wanted to show you this. The reason why I wanted to show you this chart for sure, whoa, that was a crazy bad tick, hold on. The reason why I wanted to show this chart for sure, or the other reason was to show that the S&P 500 has broken below the 50-day moving average over the last, over the last month has been that process, but we're well above the 200-day moving average, right? The current market's around 58.50, and the 200-day moving average about 150 points lower, just below 5,600. So there's plenty. That's about 250 points. That's how the math works, Dave. So plenty of further downside could happen for the S&P, but we would remain above the 200-day moving average, which is sort of a long-term barometer for market trends. Now, keep that chart in your mind as we look at the chart of the Russell 2000. Now, a bit of a different time frame. Apologize for that, but what you'll note here is that the Russell 2000 actually broke below its own 50-day moving average with authority in mid-December. We traded big time down through there and then had this consolidation phase, which I would argue looks more than anything like a bear flag pattern. A bear flag pattern is where you have a big down move, then you have a shorter term rally, higher highs and higher lows, shorter time frame than the longer trend, and a break below the lower end of that flag suggests a deeper move to the downside, and that's what we got on Friday of last week as the S&P was closing below 58.50 for the first time in the year. You saw the Russell 2000 actually complete that potential bear flag pattern, suggesting much further downside to be had. Let's look at some other kind of components to this chart, though, and just think from a technical perspective, what is the chart of the Russell 2000 telling us? So we'll start at the top and kind of go to the bottom there. So if this bear flag pattern is correct, what that would mean is you essentially take the height of that pattern and you project it from the breakdown. So a quick annotation here, I'll show you what I mean. So if this is the bear flag pattern, kind of this move, and then we kind of do a parallel move here, and I'm making the chart even busier, so sorry for that. All right, and then we'll say in red, here's the height of the pattern from this peak basically to there. and then we suggest a similar move in terms of price and duration. That would take us down to just above 200. That would take us to around a 50% retracement of that pullback. Now, what's interesting about that, right? So if this is a bear flag and we completed it, which I think we'd have, that would imply a minimum downside objective right around 202, which would take us to about a 50% retracement of the October 23 to November 24 rally. What's interesting as I'm looking at that is if you consider this a head and shoulders top in the S&P, you take the height of that pattern and subtract it from the breakdown. That takes us to right around a 50% retracement for the S&P. Now, that's going back to the August low. That was the most recent big upswing was the August low to the December peak. But some interesting symmetry with the 50% retracement coming in there as well. This would take us, of course, well below the 200-day moving average if that would actually play out. All right, just wanted to draw some lines on there to show you a potential downside objective if that bear flag is true. Now, what is happening recently? Well, I'll say a couple lines on here, and again, I apologize, it's kind of a busy chart, but I'll zoom in a little bit so we can kind of talk through some of these levels. So here's the pullback from around 244 on the IWM down to around 213, which is where the 200-day moving average is. Today, we're actually bouncing off of yesterday's low. So yesterday on an intraday basis, we traded almost to the penny to the 200-day moving average. Today, which is not an unreasonable expectation given a test of the 200-day. Today we're getting a bit of a bounce higher. So the real question, I think, through the course of this week is, does the 200-day moving average hold? Now, it's not just about the 200-day moving average. 212 or slightly below that would be a 38.2% retracement of this kind of beautiful uptrend phase from the October 23 low to the November 24 high. So kind of 210, 212, 213-ish. Combines the 200-day moving average as well as that first Fibonacci support level. So we have kind of what's called a confluence of support right around that particular level. And so two things you'd expect. Number one, you'd expect to bounce off of a confluence of support. I think we're getting that so far here Monday into Tuesday. But the other thing is if and when we would break below there, which means Russell 2000 below 211 would clear those levels, I think that means much further downside most likely to be had. Now, what else can we do? We can also draw a trend line from the October 23 low to the next major low, which was August. And if you look, that actually lines up pretty well with the lows that we had in late December. And now, of course, we've broken below there. So today's rally, bouncing off of the 200-day, is actually testing trend line support from below. Could be a time where we find support before the next leg lower, potentially. But I think that's another sort of longer-term trend line to keep in mind. Now, what would tell me that the bear case for small caps is wrong and that we're reinitiating an uptrend? Well, for that bear flag pattern to be negated, right, for that downside measurement that I suggested down to like 201, 202, for that to be negated, well, we'd have to stop going down, right? And so how do you determine if and when small caps are no longer going down? Well, you use an indicator like an RSI or MACD or PPO or something, or we do trend lines and look for a break of resistance. So I'm taking the November high, lines up pretty well with a lot of these highs in late November, early December. That lines up with the swing high in last week, early January, where we pop back higher. And so that trend line is currently sitting around, we'll call it 224, 223. So breaking above that purple trend line, which would take us back above there, ideally getting back above the 50-day moving average, that would sort of complete a bullish rotation, suggesting that bearish expectations were unfounded, and we're most likely going to see a bit of further strength from there. So some levels above the current trading that I think could tell us, give us a bit of an all clear, telling us maybe a resumption of the uptrend for small caps. So with any kind of chart like this, I kind of have my base case, and then I have the signal that would tell me I'm wrong. That's kind of how I always think about it, right? What's the overall analysis? Okay, what's my conclusion? And what would tell me I'm wrong? So overall analysis, I would say for me, the primary sort of short-term trend is negative, given the fact that we're making lower highs and lower lows, and we've broken through, things like the 50-day moving average. So my base case is further deterioration and a break of support around 210 to 212, 213, which is what we're potentially going to be experiencing this week. What would tell me I'm wrong is we break above that purple trend line resistance and we push above the 50-day moving average around 230. Those two things happen. I will have to say, nope, no longer bearish. That's certainly a chart you want to be owning probably rather than anything else. What's also worth noting the momentum here, right? The RSI broke below 50 second week in December and has actually remained below 50 all the way through today's trading. So the momentum overall is weaker rather than stronger. This tells you there are heavier down days than up days, which is a sign of basically momentum weakness. So you'd want to see an improvement in the RSI for sure. Ideally, a rally on a stronger RSI. The RSI pushing much higher would be a bullish sign for sure. So overall, the technical configuration, I would argue more kind of neutral / bearish than anything. But a couple of things that I would look for that would tell me a bit of an all clear. Improving price action, improving momentum certainly are important, but I can't overstate the importance of sort of this 210 to 213 range, which combines all of these key levels, these support levels. And I think if you break that, would sort of give a sign of further deterioration to be had. Now, what could cause an improvement in small caps? And the other thing I would note is the relative performance at the bottom has been incredibly weak, consistently weak. And certainly from Thanksgiving through the new year, we've seen the relative strength come down, meaning small caps are underperforming. And the longer trend over the last couple of years has certainly been small caps underperforming because mega cap growth, the FANG stocks, have been so dominant that anything like small caps, which is basically betting against that mega cap leadership, just hasn't worked very well, right? And in 2024, any small cap index probably underperformed, most likely underperformed its large cap counterpart. So what kind of tailwinds, what kind of signals could tell us that small caps are going to improve? Before we get to those three charts and some of the key takeaways to think about, I do want to let you know, if you like my work, I'm so thankful you're watching me here on Stockcharts TV. You can get more Dave elsewhere as well. Number one, our market recap show is called Chart This with Dave Keller. You can find that on my YouTube channel called Market Misbehavior. I hope you'll check that out. Every weekday after the close, we air that live, and we live stream it on YouTube as well as X, Facebook, and LinkedIn at 5 p.m. Eastern, 2 p.m. Pacific every trading day. So check out that if you want to follow these signs of the small cap space and really think about some of the signals that will occur in the coming days and weeks. Follow my daily market recap show there, and you won't miss a thing. The other thing I'll tell you, if you really want to learn more about the techniques that we're using today, if you want to improve your market awareness by upgrading your use of technical analysis and behavioral finance tools, our Market Misbehavior Premium memberships may be a perfect gift for yourself to start off the new year. You can find more information at marketmisbehavior.com/premium. And I would encourage you to use the code Stockcharts when you check out for 20% off your first 12 months on any plan. Our premium memberships combine three important things. Number one, virtual courses. So I'll teach you all about technical analysis, behavioral biases, what tools you want to use, what routines you should use, all based on my experience as a technical analyst. Second thing you will get are our premium members-only reports like our weekly flight plan, which comes out every weekend. That's our main look at what just happened in the markets. I look forward at what is most likely to come, some of the key levels and patterns that we watch. And if you follow my market recap show, that weekly exercise over the weekend for my premium members really will help you better understand the incremental data points that we're gathering through the course of every trading day. We also do a monthly chart review where we apply our proprietary market trend model to a bunch of different asset classes and think about trends and trend shifts. Finally, you have the ability to ask questions and keep yourself accountable. We have a members-only community, which is pretty active. If you ask questions in there, I'll probably come in and answer. You may get some of the other premium members weighing in as well, but it's a great time and opportunity to compare notes, to learn from each other, and hopefully learn some great lessons about technical analysis applied to the current market environment. So again, more information on our premium memberships can be found at marketmisbehavior.com/premium. You can also scan the QR code on your screen and make sure you use the code Stockcharts when you check out for 20% off your first 12 months on any plan. Getting back to the charts here, three tailwinds or three potential tailwinds for small caps to improve. If small caps are going to start outperforming, where would we need to see strength? Three charts. Number one, the financial sector. And this may be one that is a surprise to you or maybe not, right? If you know the S&P 500 and if you've really dug into the construction of that index, which I have done many times over the years, our most important U.S. benchmark is dominated by growth sectors, and particularly one growth sector, technology. The technology sector makes up about a third of the weight of the S&P 500, and it's those big mega cap names like Microsoft, Apple, Nvidia, other semiconductors, other hardware companies, other software companies, a bunch of other things as well that overall comprise about a third, about 34% of the S&P 500 is all just the technology sector. The small cap index is not dominated by technology. As a matter of fact, the two biggest sectors in the small cap ETF, the IWM, are financials and industrials. Industrials are actually the largest, followed closely by the financial sector. Now, the reason why the XLF, I think, is an important one to watch, obviously this is a large cap financial index and ETF because it's tracking the S&P 500 financial companies, but it's a lot of banks. Earnings season is kicking off this week, and it is dominated at the beginning by a bunch of financial institutions. On Wednesday, it's companies like JP Morgan, Citigroup, Wells Fargo. As you go through the week, you get into some of the smaller names, things like regional banks, and that is where the small cap ETF is very open to, or very heavily weighted compared to other groups, would be smaller banks and particularly the regional banks. So how companies report earnings, how these regional banks report their earnings here coming up over the next week or so could have profound impact on the performance of the financial sector, particularly the relative strength. Now, from a technical perspective, the XLF is actually testing key trendline support. If you look at the October 2023 low, look at the August 2024 low, you see that lines up pretty well with this week's current low, right around $47 a share for the XLF. So the XLF is testing a key trendline support as we go into earnings season. Earnings can often provide a significant upside or downside catalyst to a particular group and or sector. And I think watching financials this week, particularly how they talk about inflation, interest rates, and other things that could impact their business. The dollar would be another thing that I would suggest. And we have a chart on that in a moment. But I think watching the performance of the financial sector this week could be key. The other thing I would say is with sector rotation, it's all about relative strength. So watching this relative performance line, which generally speaking has been trending higher over the last 6 months. If you look, 4th of July of last year to now mid-January, the relative performance overall has been improving. We can see this pattern of higher highs and higher lows in the relative strength. And over the last couple of weeks, we've seen potentially a stabilizing of this relative performance line and turning higher. But I would look to see improved relative strength in the financial sector. The KRE, which is a regional bank ETF, may be another important one to watch. And again, look to see if that relative strength can improve, because if so, that means one of the key groups driving the performance of the small cap index is doing better, and that could be a good tailwind. Second chart I'll be looking for, the Biotechnology Group. IBB is the ETF that we're looking at here. There are a number of biotech ETFs you can track, or some of the key names as well. Biotechs have not been doing particularly well. As you can see on an absolute basis, the IBB hit resistance around 150 in late July, then retested that same resistance in August, in September, and in November. And every one of those times, the price was unable to get above 150, unable to break above that resistance. Now, it was sort of a sideways consolidating pattern, what we call a basing pattern, for about 3 months before we finally broke down. In mid-November, you saw the IBB broke below its 200-day moving average for the first time since April of last year. We bounced back above the 200-day but failed at the 50-day, and now we're actually below two downward sloping moving averages. Look at the momentum, which has gone from fairly constructive in last summer to now fairly weak as we go through the winter months. So the RSI is spending most of its time below 50, which speaks more to distribution than accumulation. Now, we are potentially finding support here in the 130 to 132 range. We bounced off of there in November. We've had a number of other bounces off of support. However, I'm concerned about a potential breakdown here. Here's the kicker. Biotech is one of the other big groups weighing in on the Russell 2000 index. If you look below the sector level to the group level, you'll see things like regional banks and biotech, which are pretty big weight. So if biotechnology would start to improve, and that's obviously in the healthcare sector, which has been an underwhelming sector on a relative basis, and biotech has not done particularly well over the last couple of years, but if biotechs would find support, if you start to find a rally with the IBB pushing back above moving average resistance, if we see an improvement in price momentum and especially in relative strength, again, that's one of the bigger groups within the Russell 2000, and strength there could imply strength for small caps as well. So when you think about something like the Russell 2000, we can obviously analyze the chart of the IWM or a broader index, but looking at some of the key groups and sectors and how they are doing can help us maybe have a better understanding about what may or may not be driving outperformance in the small cap space. Final chart, the dollar, right? And the dollar has been actually trending much, much higher over the last 3 or 4 months, coming off of a low at the end of September. We're now making a new swing high here again this week. So as the dollar is getting stronger and stronger, and as we're getting into earnings season, you really want to pay attention to what some of the technology companies, some of the larger technology and communications names, which are big multinational companies, which make a bunch of their money, bunch of their revenues outside the U.S., because they will have to convert those non-U.S. earnings back to U.S. dollars. And the stronger the dollar is, the less awesome those non-U.S. earnings end up being in terms of their impact to the bottom line, because you have this currency effect, right? A stronger dollar makes your non-U.S. revenues less valuable when you convert them back to U.S. dollars. This is something you're looking for outside of financials and biotech. I mean, this is more something that will impact large multinational companies, so it's not as much small caps. This is more of a large cap phenomenon. But 2024 was dominated by the mega cap growth stocks, right? The Magnificent Seven. Those companies make a lot of their revenues outside the U.S. I'd be very keen as we go through the next couple weeks through the meat of earnings season here in the first quarter. Do you get a lot of discussion about a stronger dollar and its impact or potential impact on revenues? If so, that could mean mega cap growth starts to underperform. And if so, what's going to emerge as a new area of strength? If it's value-oriented sectors, things like financials and industrials and healthcare, don't look now, but small caps could indeed start to outperform. So I would say the stronger dollar certainly suggests a much better environment for small caps than large caps. And I would say continued strength in the dollar could be a great tailwind as well. So there you go. What do you think about the case for small caps here? Do you think they're a good opportunity in the first quarter? Why or why not? Why not? Make sure you drop a comment below and let me know. We talked about the Russell 2000 ETF. 3 key charts to watch: financials, biotechs, and the dollar. And I would encourage you to follow all of those along with me on our market recap show called Chart This every trading day after the close on my YouTube channel called Market Misbehavior. For Market Misbehavior, I'm Dave Keller. Thanks so much for watching my show here on Stockcharts TV. And remember, it's always a good time to own good charts. Have a good one.